Hey Pexy, how's it going? Must be early morning for you, man. Surprised you haven't slept yet. Hey Gordy, how's it going? Both of y'all are pretty much milking the markets. 1 a.m. man. Yeah, I appreciate you being here, man. I don't know what to say. 1 a.m. You're still here on a Friday night. But yeah, how's your trading going so far? Yeah, 8 p.m. here. Yeah, that's what I'm saying. It would have been midnight for me, but while I was in Asia. So I'm happy that I'm not there right now. But yeah, we're gonna talk a little bit about trading plans. There's a bunch of people that have been messaging me for the past week, especially. It seems the channel has taken off the past week, with a lot of money coming in to people's accounts, maybe. So I just wanted to do this. It's obviously being recorded as well. So yeah, we'll post this, keep it as precise as we can. So before we kind of get started, let's give it a few more minutes. In the meantime, so I'm not going to be around probably Sunday Asian and maybe Monday as well. But again, if I'm able to, I will definitely jump on. I'm just planning to maybe travel a little bit for those 2 days, but let's see what happens there. RDD night is still young for you. Yeah. It's making a lot of money, man. I swear if the markets were open right now, she'd be right at it. All right. So creating a trading plan. We've spoken a little bit about these things. We've looked at an Excel sheet a few months ago, I believe. Kind of some of that, but maybe we're going to go a little bit more advanced. At the same time, trying to keep it at a beginner level. How I kind of prepare myself for the year. How I kind of look at the pairs that I'm going to be trading, creating a plan around adding new pairs. Like this year we did NAS. Again, we made a lot of money with NAS. I added USD CAD as a pair and made a lot of money there as well. I have some active swings there, hedges there. So right now we'll kind of look more deeper into the trading ideas that I kind of come up with or stuff that I'm looking at. So for example, there's a lot of concepts that go into it as well, a lot of research, but we'll try to keep it as basic as possible. So obviously, first step is always, I've spoken about this a lot of times, is analysis, right? In ES, right? ES as in just too many short forms that people have been throwing at me, so I cannot guess what it is. But yeah, a lot of pairs in the markets. I'm also looking at like right now. I was speaking to Karan the other day. I know him personally outside of streams. S&P 500. Yeah. Okay. Yeah, S&P 500 is also something I have been looking at, but I'll probably not do it for the next few months. Maybe November onwards. Maybe I'll look at it as adding it to my let's call it trading stack. But yeah, and again, analysis, research, understanding the requirements around it, that's something that's really, really important when we are adding creating a trading plan. I've spoken about this also in the past, but like the first step is obviously analysis. We want to do we want to know where the market is heading. We want to know what kind of market movement is there, how the market behaves, what story it is telling us. We still follow the same principles, and we still we make a lot of money that way. I know during my time away, I'm probably not spending too much time on the charts and sharing as much analysis as I can, but I've been back and we've been doing, I guess, extremely well. And we'll continue to do that. But why I am able to take maybe 2-3 months off, why I take that time off, why am I looking at certain trading ranges, how I plan for those time periods as well, because I'm still trading those days, but those are all positions that I've been maybe putting in for days, months, and weeks ahead of it. So we'll kind of look into some of that. So yeah, trading plan. How do you start creating your trading plan? Obviously, it starts with having an account. At the same time, it could be a demo account, it could be a live account, whatever it is, but it shouldn't be very high risk if you are new to trading. Again, it has to be a small account, maybe $500, $1,000, whatever makes you feel comfortable. But it should be maybe 1% of your income is what I generally recommend people. So if you're making $1,000 a month or $10,000 a month, probably don't spend more than maybe 4%, 5% of your account size. If you're starting out, use 1%. So it's maybe $100, $1,000 based on your income. I don't know what kind of income people have, but usually that is something that I recommend. Start with a small account size, and then obviously we look for how we want to grow that account, right? That's the next step of the trading strategy. So first thing first is obviously we want to analyze the charts. We want to understand where the market is headed, what kind of story it is. So while we're doing this, we're going to do a quick review of gold, look at it from a weekly perspective, monthly perspective, 3-monthly perspective, understand market conditions, understand how the market is moving, what kind of structure it is forming. So there's a lot of basics that go into it as well. So that is a completely different thing to learn about. Today we're going to look at creating the trading plan. That this includes, we'll talk about risk management as well, but we want to look at possible setups where we will be actually taking these risks and which of those levels become high risk versus low risk. So what kind of trading sizes you should be taking a look at, right? So let us take a quick look at gold here. So the first thing I like to do is every start of the year is, or even you can do this every now and then, you can look at a 12-month chart, right? Now, what is a 12-month chart telling you? Again, it is just giving you really less amount of candles, telling you what kind of momentum exists in the market. Now, if you look at the structure here itself, we created a flag on 12-month candle, right? In a 12-month space. This pretty much tells us that price again comes back into that 2000 range. We're going to keep going up and up. So maybe the next couple of years, 3 years, 4 years, we are probably not going to be going all the way down, right? This range is something that's never going to exist. So we know that story. But now we have a comfortable range. We know that long-term gold is bullish, right? First story clear. So for the year, obviously, it's not going to give you an analysis where it is going down. But from a 12-month cycle perspective, when price gives you a pullback, you know at least that you can hold a swing trade for days, months, maybe even weeks. Even years, right? So, okay, that is clarified. I know that gold is going up. I'm going to look at some charting tools. So let's look at this channel here. Wrong thing. I want to look at it from here. Start there. We started there. So now if you look at the 12-month cycle and we look at how the market is moving, what it tells us is we have reached the top of the channel, right? So 12-month is telling us, okay, we should be able to reject into this range. Perfectly fine. Let's dig deeper into the 3-month. So you can look at 6 months as well to get a better analysis, better understanding. So you can see 1, 2, 3, 4. So the channel bottom is definitely formed. Now, is the top technically formed? Well, top is technically getting broken, right? So is there an adjustment that can possibly be made to make more sense of it? I believe. This could be the one that you could look at based on the 6 month. Now the 6 month target goes a little bit further up into 25.29. Okay, perfectly fine. Still bullish segmentation. No reason for price to reject right now. Uncharted waters, not a lot of structure to the left hand side, but a lot of support sitting at 2060, right? We have 1, 2, 3 sticks, and then closure into that range, and then price continues. So now we want to come back down and look at, if price comes down into this range, I know that I need to monitor and probably look for buying ranges into this area. So 12 month and 6 month has confirmed for me a structure that I would be trading in. So for this year, long-term trading plan is I want to be looking for buys when price comes back into this range, right? We are in month 5, so that means the next 6 months we could see a pullback coming in. So you can see 6 months, right? Not a lot of imbalance sitting on the 6 month, right? Just a little bit sitting here all the way down to 1300s. We know that we're never going to see that, so no point in expecting something of that sort. But we know that price will definitely be coming down into this range in the next 6 months. So one more month to go, we tap new highs, and then we probably start to see some rejections coming in the month of April, and then in the month of June, and then July we might see price dipping down a little bit, ranging, and then clearing out that imbalance there by the end of December, and then pretty much we continue our way up, right? So 6 month cycle could be down and then further up. So let's see how fast we reach there. But I got a decent amount of confirmation there. Then I want to look at 3 month cycle, again, top to bottom, right? Highest time frame to the lowest time frame. Lowest time frame for me is usually 4 hours when I'm creating a plan, and those plans are based on take profit levels. Now, based on the target I set, looks perfectly well. 3 month is giving me a clear indication of that, right? I have a good plan set up right there. Okay, and perfectly fine. So at this point, what I will do is I will mark off 25.37. Is there any margin? 540, 50. That's next month, right? So this month, so far, based on the channel, I'm seeing 25.36 for 8 cap chart. Okay, perfect. So that is where I'm expecting now, say, for the price to go. I now know that I probably want to look for sells in that range. So what kind of sells can I look over there? Number one is I need to understand that this is, again, high risk because there's no rejection ranges here. So I'm going off of 1 wick, no wicks before, no rejections before. So that means I need 2 rejections in that range to take a sell. So what kind of a rejection wick, how do we consider that? So we need the next monthly to start, go back up, maybe 25.54, 56 is the range where it goes up and then goes down. So if I'm looking for shorting positions from a 3 month cycle perspective, that is a huge range, right? So I cannot trade based off of here. It's a lot of pips. So my target is to try and narrow it down further towards the upside. I will go into lower time frames and look at that setup. But this is pretty much my range. I know that this is how far I can hold it. And so I want to be collecting maximum profits here. So trading plan, part 1 is I know what ranges I could be looking for sells. So if I'm taking trades, I don't want to be looking for swing sells in these ranges, right? I'm fine if I miss the trade. This is why the previous one where price rejected, I said we're fine if we miss it. We cannot track every rejection range where price would reverse. All we can do is trade the structure. Structure tells us price could tap into a range and then reject there, right? So based on what we know, we have a trade set up ready. This is where I would be looking for sells. Okay. And then I know that I want to be looking for buys in a similar range. So same thing, I will look for buying positions. and obviously adjust those trade setups based off of lower time frames. Let's say this is going to be maybe not even this. This is how long I might end up holding the buys all the way up into maybe 2700s if I get this retracement. Ideally, we may just go down, form maybe another flag, and then go back up, right? So, okay, we have that perspective. This is the setup I would be looking at. Fine. I have a swing sell and a swing buy in there. Now, going into monthly, can we expect price to reject in that range? Yes, why not? But we could see multiple rejections in this range, right? We have a top wick that is getting filled up. The current monthly should be able to drive further up and then reject into that 2500 range, 50% target of that 3000 mark, right? That means rejection coming back down, sending price further back up. All right. My setup looks good. I'm more confident about this. My analysis tells me more about what I'm supposed to be targeting for the entire year or for the next 6 months. So 12 months to 6 month cycle, I know how much money I can make. So I want to be looking for a better risk positioning here. So meaning I want to keep building my floating profits, collecting maximum take profits within those ranges. So that brings me to second most important point of creating your trading plan is take profit collection and trailing stops. So trailing stops used are really, really important in swing trading. If you're not using trailing stops, you are not a swing trader. You are just holding on to an existing entry, which means you're trying to hedge. And if you have enough information about hedging, you know that you would need a huge account to be able to hedge trades on something like gold or other volatile pairs. So if I want to be hedging on certain trades or certain pairs, maybe my account size needs to be close to $200,000 to $300,000 of my personal funds, not a funded account. So funded accounts have their own rules and a lot of different things, swap fees and so on. So obviously that is not worth holding hedges there. That floating profit is of no use to you. And no use to them. So eventually, you'll get locked out or they'll collect their money from you. So you can't do that. So personal accounts, that's how big you want to do that. So hedging on personal accounts, you can do that on small accounts as well. But as long as you're collecting profits, as long as you're doing trailing stops, because you're creating your own leverage. So that brings me to the third point of your trading plan is creating your leverage. Now, this is how I would be creating my own leverage. I would be able to have a huge amount of floating profit across these trades while I'm adding more floating profit as price keeps moving up and down, right? That allows me to trade more often, allows me to take better risk. So if my account size is $1,000, I'm able to, with a floating profit of maybe $200, overall account size is $1,200, but the $200 floating allows me to take additional risk on top of my $1,000. So if I'm maybe taking a margin trade of $20, I can now take a margin trade of $30. So I can add $10 more to my tradable margin, which is what is really, really important when you're creating your own plan of action. Now, digging deeper down. These are the level entries that I'm looking at, right? We have divergence forming. Now, higher time frame is where we are looking at setups in these ranges. The weekly, if you look at RSI, is giving us divergences. What is the story it's telling us? Based on the 12-month, 6-month angle and the 3-month angle that we looked at, the story kind of combines together on the weekly. That means when divergence starts to get formed, we see a possible loss in momentum. That loss in momentum seems to be coming out now, which is a huge advantage for you because your analysis seems to be something that can work out. Now you have additional confirmations for those trades to work out. So these are ranges. Now I've been saying 25.50, 25.56 is around the range I've been looking for sells. When price rejected a few weeks ago, I told you guys like that's something that I was expecting. Price reversed from there. But we want to buy the pullbacks. We bought the pullbacks and we're holding on to those trades now. Now, the important part is why were we doing that? That is because the targets speak for itself. We know what's happening in the markets. We know what is going on fundamentally, and it's not going to change. It's not that time of the year when these things change. Generally, these things come about to change end of the year. So October, November, December, this is where we'll see these things changing, and the momentum will give us a better drop. So what is this? What does that leave for us? Currently, it leaves for us a story, and the story is we are on track for our targets. Now, if you look at this is maybe May, we consolidate a little bit, go back down, take support, jump back up, take down, jump back up, eventually reaching those targets by July. So by July and August, we might see the targets being tapped and consolidation a little bit into that range, eventually taking a break towards the downside. So in through the next month is my target is we'll see some rejections coming in, right? That will be the last month of this 3-month cycle. All right. So swing setups, confirmations ready, right? Now this also gives me possibilities for the day trade. Now when I'm looking for next week, I know weekly has created a flag. I've been saying when price created these two bearish candles that we are creating a flag, and that's why we took buys and into the 2330 level, and we're holding on to those. Now when price breaks above this range, it has closed above, fill that wick. So now if I put this here, we can expect a retest and then bounce up, right? So retest, bounce up, something that we can definitely expect. So the story is clear. Day trade for the weekly is, or swing trade for the weekly is for a price to tap into this range. I take my entries and then let it run, collect maximum take profits along the way. So how am I gonna split my risk here? So if I can take 2% risk maximum, this trade is where I want to use that 2% risk. Any other trade that I take between these two ranges till I get more weekly candles is going to be 1% or less. That is to build my equity while building floating profit. So this is how I would make that switch, right? So keeping it plain and simple. So going down into the daily. Now in the daily, what we know is price creates a structure, can create a probable support on the daily consolidation because we have kind of created a cup here. So we could create a handle and then continue going up. Well, ideally we did create a cup, a handle, and then push up, right? So that's kind of happened already. But a further push up is definitely something that we can expect based off of level of support. So now I want to go for long position, best buying level. Is my stop loss narrow? No, not narrow enough. So we'll adjust that based on lower time frames. But this is the range I would be expecting for price to continue. All right, this is my current target, is for price to go up all the way into that range. Now, okay, I have a setup for the weekly. I have a setup from the long-term monthly, 12-month, 6-month perspective. Now, I want to look for high risk and low risk positions. So what is low risk? This is low risk because we have structural confirmation. We have RSI confirmation. We have that cup and handle formation. We've broken above a previous daily, weekly level where if price now comes back down, it can definitely bounce off of it. Good level of support being created there. Good amount of momentum also created into that range. Initially, we saw massive rejection. Now we saw massive push up. So now we can definitely test and then bounce back up, right? So we have that additional form of confirmation sitting there. What else do we know? Okay, is price breaks above the previous high, we could see some rejections coming into that range. So day trade, right? Now, why I'm calling that a day trade and not a swing trade? Because we have strong level of support sitting here. So what I could target is a quick short position, very narrow stop loss. and trade into this range. So I have a small trading range, still 370 pips, massive trading range, 241 pips, with trading levels, take profit levels between these. You can definitely collect at least a minimum of 800 pips in this trade here through the week. So you have 800 pips of guaranteed profits sitting in this range, plus 370 pips. So you have over 1300 pips sitting right there, 1 day, 1 week. So 2 trades are going to double your account in that week with minimum risk, right? Minimum risk. But you just got to know you're putting in 1% here, 2% here. So as this 2% keeps going up, you're collecting profit, allowing you to take 1% risk every time in these ranges. Okay, so that is the basic perspective in which I like to take that trade. Now, I have a basic trading range where I'm going to be trading in. Perfect. I know where price can go, so you can look at that 4 hour. We'll clear out that imbalance and then continue up. Decent amount of range for price to go down and then go back up. Okay, so we have that as well. Fantastic. Now I want to look for conservative side, right? Because we also want to do risk management. What happens if price rejects and continues down? Well, if price has to go down and do a correction, there is a structure sitting at least on the 4 hour, right? This is the structure that we could look at. Ideally, I want to look at this here. So this is one of the structural ranges that I can see. And this is a better structural range. We have 1, 2, and 3 taps. So this is the range I need price to break. So our sells are pretty much in order. Price comes back down, takes a support into that range. It should go bullish. It does not. It breaks. It comes back further down. Can still go bullish. Strong support on the 4 hour into that range. Not a lot of imbalance sitting on the 4 hour there, right? A little bit sitting here maybe, but that's pretty much it. And then a bit over here. So that tells us that 4 hour could see some amount of pullback coming in the next week or the next week. So 2 weeks from now, we'll see some amount of rejection going down. So when we look at the daily, okay, the daily has a range of going down. Yes, why not? Definitely something that can happen. Does it have to happen immediately? Maybe not. So we might break above, create a new high, reject, go back down, create support, go back up, and so on and so forth, right? But yeah, 4 hour perspective, giving me structural evidences that price could break this range, given that RSI is kind of losing momentum and 4H is in a divergence at this point. So sells coming in soon. Is that a long-term sell? No, by no means necessary. Daily, weekly doesn't give us an indication for a strong sell at this point. So that means I have confirmation about price wanting to go up, small correction coming in the next 2 weeks. So I'm cautious about upcoming sells. That means I want to take corrections below this range. So I want to take a short position, a possible short position into this range right here and targeting it all the way down into that range right there. So 809 pips across all take profits. That gives us what? Maybe close to 1500, 1600 pips minimum, right? And then we have 1455. So we have 1455 pip trade right here. Considering everything, this could be giving you like 14,000 pips, 1400 pips. So that means a minimum average of 3,000 to 4,000 pips. Trade through the week is what this buy could give you. So you need confirmations, price not breaking structure, you get that continuation. Daily currently supports it, so we should be able to continue a little bit further up. Right, so perspective, trading plan, risk management. What is my risk here? This is high risk sells. Yes, we don't have a lot of structure here, but this is the best selling range right now. If I wanted to go for sells midway in between this range, there's no reason for me to look at those sells. There's nothing that is coming up and giving me confirmations, which brings us to 4. When you're taking these small range trades, you need multiple levels of confirmation. So when I'm taking trades, I'm looking at channels, I'm looking at trend lines, I'm looking at triangles, I'm looking at chart patterns, candlestick patterns. So there's a bunch of things I'm looking for confirmation along with RSI and higher time frames. So higher time frames have already given me what market movement is something that I can expect or keep my bias on, and lower time frames are giving me indication towards what direction and what size of trades and how big of a risk should I be taking in those positions. So it's a clear confirmation what kind of trades you want to be taking there, right? So this is basic risk management. Now, when we talk about risk management, it's often so that people talk about managing risk in three different ways. Is if you go into drawdown, you close 50%. So managing risk, what do people say when managing risk is, I'm going to manage risk when price goes into drop down. I'm going to close some positions in drawdown. That is not the way to do risk management in my books. Most swing traders in the market are willing to take their stop loss. There's a reason you keep that stop loss, and a lot of times you have seen I'm taking pending positions 90% of the times. When I'm taking pending positions, I am off the confirmation that if my stop loss gets hit, I have made a mistake. I'm not going to I'm not going to blame liquidity. I'm not going to blame market structure or stop loss hunt or any of those concepts. I don't believe in those concepts. And I believe the reason for my success today, or me making a lot of money in the space in the short amount of time that I have, is to that concept. I don't want to get stuck in retail trading ideas. I want to be stuck in growth ideas, not new concepts, not new, indicators and so on, but more towards simple strategy, simple understanding, simple trading patterns, but learning patterns as a part of that. So why did my stop loss get hit? Did I take a bad entry? Did I not realize there's a consolidation in the historical range? Did I not look at a possible rejection range? Did I miss any dojis in momentum ranges? So a lot of different things I have to look at, and I always study my losses, and that helps me take better decisions. So previously I used to take 30 pip stop losses. That was my criteria. I realized that as price, especially in gold, as it keeps moving up ranges, so from 1500s, 1800s, 1600, 2000s, the stop loss size changes. So as price kept on moving up and up into those ranges, staying above 1800s, closer to 2000s, I realized that my trading range or my trading strategy should have a bigger stop loss for the volatility in the market. So from 30 pips, I went up to 45 pips. And as of last year, as price keeps on going with war, we upgraded that to 55 pips as the maximum criteria for us. Above 55 pips, I don't find the reason to have that kind of a trading range beyond that. It just doesn't make sense, right? So that is how I want to do it. So some people say close some positions in drawdown. That is not the right way to do it. So let's put an X and this. What is the right way is right way in my books is learn from your SL hits, understand if you had a good position, good entry, that means, why your SL was hit, what level risk range were you trading at? So these are the most important parts for me when it comes to managing risk. Let's keep it here. It stays clean. Okay. So managing risk for me is identify and learn from your stop loss hits, why your stop loss got hit. Don't blame it on liquidity grab, stop loss hunt. Forget about those concepts. Understand rejection ranges. Is your stop loss size good? Is your position entry good? Are you trading between the ranges, or what's going on? Understand what is your entry level. Did you take a good entry position? So for example, I always say keep 1 or 2 pips above the level you expect price to tap because of spread gap. So is that part of your entry? Is that a good entry based off of that physical principle? If you've accounted for your spread, you can take a pending position and let the market do its work for you. A lot of times people send me a message, how did you take that sniper entry? Or we don't take sniper entries often, right? We'll have some amount of drawdown. That is what the stop loss is. So if price, that is the scope that I'm giving myself. If I'm willing to take a stop loss, I'm willing to make more money. If I'm not willing to take a stop loss, I'm not willing to learn. That means I won't be able to make that much money. So scalp traders, for example, again, they make money, but they don't make as much money as a swing trader does. An average swing trader doubles or triples their account in 6 to 8 months every year. That is how much they can grow, right? It's just because you're collecting every possible pip as price moves, as long as you hold trades and as long as you're collecting multiple profits across that trade. So there's a lot of things that go into it. Next thing is, if your SL gets hit, why was it hit? Did you do something wrong? Was it that there was a news event that happened that took it down? What was that news event? What kind of an economic impact did it have? Is there a fundamental way for you to know or forecast that event? Right? That is something that helps you learn. Next thing is, was your stop loss too small, or was it within a rejection range? Was it within a consolidation range? So these are places where people, position their stop loss. So for example, I'll give you guys is, say I want to take this entry. Left hand side, there's consolidation. Over here, there's no consolidation. Scalping traders, retail traders in that situation, especially, what they do, again, scalpers are retail traders. Professional traders and hedge fund companies do not scalp positions. So what is going to happen here is consolidation, a lot of consolidation. That means multiple rejection ranges. Wicks could be at any given time. Price could reject in this range, in this range, in this range, or all the way down into this range. So that creates a huge stop loss space for you. So either if you want to take that trade, your risk is high, yes, obviously, but you could take a smaller risk. But keep in mind that you might have to have a comparatively bigger stop loss than you might like to have, right? So 70 pip stop loss. It looks like that is the best range based off of the 4 hour. Now you can obviously adjust it based on 1 hour, but now you know that there is a risk there. So you are considering that as a possible risk range before trading that range. You don't want to get blindly into that area. Smaller time frame is telling you how that stop loss could be hit. Daily and weekly time frames are telling you that you probably need 100 pip, 115 pip stop loss in that range to be able to trade that entry. So if you have a big account and you're trading hedges, that is how big your stop loss is. When I'm taking a trade on my hedging account, my stop loss size can be anywhere between 100 to 200 pips. That is maximum for me, 200 pips, but 110 pips is usually my range. Those are all pending positions on multiple trades, on multiple pairs that I trade on. On an average, on the hedging account, I hold up to 6 different set of pairs, right? So a lot of floating profit that is being collected, plus similar positions for day trades and swing trades. So a lot of money being collected into those ranges. Allows me to get comfortable taking additional risk when I need to. So Okay, so we have some of those things. We take those trades, we take that money, we let price do its thing. Now, when we are taking a sell or a buy, you need to know what level of risk range it is in. So for example, let's look at the stream here. I said risky buys. Do you know why I said risky buys? Because there's weekly resistance, that is rejection range, strong rejection range. Not a lot of bodies sitting in this range makes it high risk, so there's not a good level of support for price to continue. We created a minor support, but you can see the minor support could not give that momentum. So we might now retrace, take support, jump back up, tap into that range, come back down, maybe all the way down into this range again, go back up. Eventually, a better pullback, I believe, would be somewhere into these ranges here. Maybe 23, 20, 2200. This is how far down I would be looking for a better pullback on the higher time frame. But you have clear indication how price is moving, what price is doing, which direction price is going, right? So this is where it becomes risky trades. Now, over here, same thing. Not a lot of structure sitting here, risky position. But we have a decent amount of structure sitting here, so comparatively low risk, right? What did we add to reduce that risk is confirmations. So this was high risk because of the risk of price breaking below. RSI into that situation was below the moving average line. So it dropping after that retest is a high risk zone for you. And so you don't want to be taking additional entries there if you cannot take that risk, which means you've maybe taken a loss or your account size is too small. You only want to take conservative positions. So this was a conservative trade. Price breaks, gives you that retest, it goes up, right? So if you had taken this or this trade for the day today, you would have made over 1,000 pips. So a lot of money sitting in the books, right? Now, what is the next thing? So the next thing when you're managing your account is how many different pairs are you trading on and looking at all of these structures and creating those structures, because you got to make a decision. Number one, you don't want to be trading. If you have an account size of less than $10,000, and I'm saying that $10,000, if you have it less than that, you don't want to be trading more than a one volatile pair at a time. Instead, you want to be trading maybe one volatile and 2 Forex pairs or 3 Forex pairs, like stable pairs, right? Even within Forex, there's GJ, there's UJ. These are, again, high volatile pairs. They give erratic movements, and given what they're doing right now, JPY basket being weak, them just going bullish, you don't know where price could just reverse. You don't know what price could do. You don't know what kind of an economic event is going to change the trend there. So that all of that range that it is currently driving in becomes high risk for you. So you cannot trade those pairs. You want to take something like AUDUSD, EURUSD. You can take USD CAD, a little bit volatile, but not extremely. So you want to make combinations of those pairs if you're trading it. So that is also part of managing your risk. So if you want to secure your account, if you're not in a hurry, so making money, this is not quick money scheme, like quick money, easy money scheme. This is effort-based money, but if you take the effort and you give it the patience, you can grow your account from $1,000 to $10,000 just with these basic things I mentioned in a matter of 6 months. In a matter of 6 months. I've done that multiple times. I've shared some of those, 500, 2,000 in a month's time, 100,000 to 1 million in a month's time, right? We've done multiple accounts. I did when I was in Asia, I started a $1,000 account. I flipped it to $10,000 in a matter of 2.5 months. So that's 10x. How am I doing that? Because again, same ideas, right? These kinds of setups, multiple trading positions. So there's a lot of effort that goes into that, and you need to understand the patience you need to have in those ranges. And then practicing on demo accounts, even though you are good at maybe live trading, you always want to challenge yourself, because traders, it kind of sometimes happens that it gets into your head that you are the man, you're making a lot of money, you can get cocky, and you can also get distracted sometimes by your own overconfidence. And that is the spot where you want to challenge yourself. So if you don't want to be blowing your accounts as they're growing, you want to be taking trades on demo accounts of bigger sizes just to adjust into it. Otherwise, what mentality comes in psychologically is you grew a $1,000 account into 10,000. Your lot sizes now maybe should be 0.5, maximum 1 lot. Instead, what you're doing is you're trading 2 lots, 5 lots. You're over trading, you're over risking. Why? Because you think you flipped 1,000 to 10,000, now you can take bigger lot sizes. But that also means you're going to easily blow your accounts. So you don't want to be blowing your accounts. How do you save yourself from blowing your account? Well, this is how you save yourself. Is challenge yourself on demo accounts. If your expected target is 1,000 to 1,500 by end of this month, create a $1,500 account on a demo and trade the same positions. Use a copier. There are free tools out there you can download. As you're trading your live account, you can take the same trades there. Get used to the stop loss hits there. Get used to the drawdown levels. Get used to the lot sizes and everything. And trade over there. So that will help you condition yourself psychologically, right? The biggest problem retail traders have in terms of managing risk is overtrading. Overtrading is a huge risk. And that happens to the best of us. 90% of traders in this market have blown multiple accounts before they became profitable. And they're still struggling. A lot of them are still struggling because majority of them are scalpers, right? They take 2 trades, 3 trades, 2 stop loss hits, 1 profit, 20 pip, 25 pip stop loss. It's a huge loss. You make 10 pip profit and then you're pretty much happy. If you're looking at profit and loss ratio, maybe it looks good there, but those numbers don't mean anything. For me, it doesn't mean anything. I don't look at profit and loss ratio. I'm looking at the number of pips I can collect and the number of pips I lose. So for example, this month alone, across all stop losses that we would have gotten hit, the maximum amount, I have it here somewhere. So we have 257 pips stop losses in total this month, and we are well above across all take profit collections so far, excluding any running trades. We've already hit 4,300 plus pips for the month in 17 days. Now, 250 pips stop loss, right? 4,000 pips profit. It's a huge amount of money. So for me, profit and loss ratio doesn't make any sense. It's about how much pips you can collect, how often you're collecting them, and how well your trading strategies are between those trades. So if you're trying to learn and if you're trying to make money off of trading, you need to understand how to do that, right? Now, the next thing that comes into factor within this is after you do this, you're doing your analysis, you're keeping these things in mind. Do not close, or I know that you might be used to it right now, but you gotta change your mentality around getting scared when something is about to hit your stop loss, because the moment you get scared, that is the moment you lose your profits. So if you're scared of losing or getting your stop losses hit, this space is not for you, because this is the risk you're putting against this profit. So if you cannot take that risk, and if you get scared midway that risk, just remember this. As price drives, you're also going to get scared and close your trades. What's it going to do is price continues in the direction you want, you're going to want to go in back again. So you might not go, you might stop yourself 1 time, 2 times, 3 times, 4 times. But the best of the best that I've seen have always struggled with this. They will always maybe take a 3rd trade or a 4th trade. So it happens sometimes, maybe not every time. But those are the times where you're constantly damaging yourself psychologically and you go into losing streak. So stop monitoring it from a streak perspective, but from a pip perspective, right? That's the next part of it. Now, we looked at the analysis part. So let's look at the account part. So we've done this previously, but this is the first time we're doing it live on stream, or recording that pretty much live on stream. So want a window capture. I hope you guys can see that, right? So I will definitely share this in Discord so people have access to this. Now, this is a basic calculator that I like to use, or I used to use. I don't use it anymore. I just don't need it. I have 9 different accounts. I can't really keep track of this now. But as I got started, I just kept on using some of this and adding some more stuff to it. Now, this is based off of a little bit of this is positioned to look at it from a futures perspective as well, commodity trading perspective, high lot sizes and so on. But again, I'll adjust this for you guys. So these are the maximum lots that you can trade on your account is 500 lots. But I want to be risking, say I have $1,000 account. My average lot size, so the cost of margin for each lot is say $10. Stop loss that I want to be putting in is $20. I'm taking 1% risk on $1,000. That means I'm willing to lose $10 across that pip value, right? So risk per lot is, I probably want to take 0.02 lots, 0.01 lot. Right, so that is basic expectation, and number of pips that you can make through that is maximum you want to make is say 50 pips. That is your target. You can make $25 profit. So you risk $10, you make $25 if that trade works out in your favor. How many of such trades did you take in a given day? You can put it in there, risk based off of that, and collect those profits and calculate how it's working through, right? Day in and day out. Now you have 1,025 in your account, right? Your account has grown by that 1% risk. Still, you can increase your risk, but eventually, as you keep growing your account size keeps growing up, you're able to risk more and you're able to reward yourself more, right? So the more you're able to trade between this account size grows, you don't pull out the money, you let it grow, you're pretty much going to keep growing your account substantially. So that is the most basic gist of it, is how do you maintain your account growth while not having to pull money out of it? What is your target when you want to be pulling money out of it? So my target when I started out, I started with a $500 account. To be able to do my first withdrawal, my target was I want to do at least $5,000 in the account before I look at withdrawals. So I grew the account, I made some withdrawals, and then eventually as stuff kept on growing, I started splitting accounts. I targeted that. So $5,000 I created. Then every profit that I would make, I decided that I will only pull out 20% of those profits. So for example, I had a $5,000 account. I had a profit at say $150 or $100. I'll only pull 20%, that is $20 into my account, and I'll add the remaining to my existing equity, and I grew that account. So I kept on growing it that way. So I'm pulling some money for myself at the same time I'm constantly growing these accounts. As the accounts grew to $10,000, I tried splitting that into two different accounts of 5,000 to be able to reduce that risk, to stop myself from over trading, thinking that I have a lot of money, I can hold that drawdown, I can hold that trade, I can afford that trade. Like I stopped doing that, and I kept on splitting my accounts. To the fact that now I have 9 accounts, and across that, I can take a maximum risk of 6 to 7% given the floating profit that I generate, and profit collection or withdrawal perspective, I withdraw every 6 months to a year. So I don't withdraw every month, I don't withdraw every week, I withdraw every 6 months to a year. That gives me enough space to keep growing my capital, and at the same time I keep splitting accounts. So as I'm collecting profit, compounding on that, my account size is growing substantially. So this brings us to how to trade the risk. Now, if you're supposed to maximum take a pip size of, or a lot size of, say 20 or 0.20 lots or 0.02 lots, every trade you take, maximum you're able to collect 2 take profits, meaning you can close 0.01 lot and then 0.01. So instead of closing them manually, I like to take 2 positions of 0.01 at the same level. I'll put pending orders there, and then I'll let it run. And I'll have one of those collecting at a different level, mid-level, and then the second one at the topmost level. So I like to use that to understand what direction price is going and how I can make trades based off of that and keep building my account. So say 0.02 is what I took. I collect 0.01 and I try to find another entry. I put a trailing stop on the next one, next to 0.01. I add another 0.02 to the entry. Because I collected 0.01, my account has now grown a little bit. I can take an additional risk, and I have floating profit to risk off of. I keep compounding that. And that is how, in a month's time, you'll be able to grow this from this. So that is from 1 month to 30 days. In 30 trading days. So we generally have 20 to 22, 23 trading days maximum, but $1,000 to almost $1,700 in a month. This is just based off of taking one 0.02 lot trade with an average number of 50 pips profit collection. You can grow it to $1,600. So why can you not double it with floating profits? In less than 23 days, you can probably double your money in 1 week if you use the strategies I use. But again, it takes time to learn and understand how all of that works. And we'll keep doing more and more sessions on it. Right? But this is the basic idea of it. Now, obviously, there's more things to kind of dig in and understand and trade based off of this. I'm just trying to think of a different way to kind of explore this. But again, if something comes to my mind, I will definitely share. And we'll actually do an advanced session or a live session in one of the streams of how I'm going to be taking that trade setup. So I'll create a demo account for, and I will trade gold on it. And I'll do a live share of that demo account as to how I'm placing my positions. What is the account size there, and then as the profit keeps collecting, as I keep collecting profits, I'll share the results, some of those, so you guys get a view of how to grow your account and how to build your floating profit, right? It'll probably give you more confidence that way. Now your average pip stop loss is obviously going to be bigger than this, because if you're trying to take swing trading on a $1,000 account, you are risking 40 pips stop loss. So you want your number of pips that you carry on to at least be $100 pips, sorry. So that is how much you can you are able to trade based off of this. So these are your lot sizes. Say, actually this is supposed to be 0.02 is what you can take in these situations, up until 0.03, and then 0.04, and then eventually you'll keep growing as your account size widens, right? So $2,000 account, maximum 0.05 lot is what you want to be taking, not more than that. But yeah, this is pretty much the idea of how I would trade, how I would create my setup, and this gives me pretty much a weekly plan. How many this is say 7 days, 5 trading days. So first day, 5th day, where was I, right? So I can track that and keep growing my account based off of that. So every week I come in, I can probably have a new sheet for that. So now next week my account size has grown to $1,100. I put in 1,100 here, and I know what kind of trading strategy I'm supposed to go through. So this is pretty much how I would be taking my trades across all of my accounts. I've been talking about a lot of things. It's very, very basic, and I've spoken about these so many times. But again, I'm happy to repeat as many times as people need me to. But again, starting with managing risk, analyzing charts, understanding where the market is going, what story it is telling, what are those rejection ranges, chart patterns, candlestick patterns, and so on. Understanding those segments, and then going into your account and actually looking at what kind of size trades you want to be taking, at what levels, now what high risk levels are, how much you want to be trading into those ranges. So if you understand these basic elements of taking trades on those accounts, then that's the only way you can be successful. Now, I'll create maybe a recorded video with more notes and more presentation perspective, so that'll be much more easier. But today I just wanted to give a quick gist of how these things are. Again, the video takes time to kind of build out with all the other content, but yeah, definitely something that I will try to get out in the next couple of weeks, so you guys will have something to look at. But yeah, that's pretty much the basic idea of how you want to be trading accounts. Yeah. Yeah, if there's any other questions sitting there, I can definitely answer those. But if not, we'll probably end the session and restart taking trades, making money in the next week. So let me know if there's any questions. If there's any questions about the Excel sheet or managing risk or psychology that you guys want to talk about, I can definitely chat about that for the next, because I got 10 more minutes and then I gotta head out. So let me know. Nothing? No questions? All right, so I'll share a version of this sheet, simplify it a little bit to make more sense for new people, new traders. So that we already have a lot of notes sitting there, but I'll share more information of how to learn or how to monitor your trading patterns, understand those parts, and then obviously we'll have a slide-based video about what we spoke about today, from managing risk, analyzing charts, setting up your weekly charts, setting up your daily charts, daily trades, weekly trades, all the way down into growing your account, how you want to be growing your account, what kind of lot size you take. And next week, once I come back from my outing, we will create a demo account and actually practice that, and I'll share those updates as we do that, right? So it'll give you perspective into how you can grow your accounts instead of people constantly messaging me about, give me $1,000 or something like that. The number of times people have asked me that, well, I would have run out of all the money I have. So, but yeah, kidding. Keeping those things aside, there's definitely a lot of ways to grow your accounts. It's persistence and patience. That is the most important part of trading. If you cannot keep patience, you're going to lose your money faster than you can make it. So patience is going to be a huge element of it. And do not come into your charts, do not open your account for trades if you're extremely stressed. If you have various things going in your life and you're not able to concentrate, you're going to lose more money. So in these circumstances, you don't want to be taking risks. You instead want to be taking less risk and managing more of your self-psychology before you enter into those accounts, right? So psychology is a huge aspect of it, and how to improve psychology. That's another topic. That's something that we can have a video about or discussion about. Psychology is not something I can just, keep talking about here. Everybody has their own ways, things that restricts them, things that breaks them, things that cause them losses. So it's more of a discussion topic where we'll probably take that in Discord, maybe next week sometime, and chat it out, understand it, understand your point of view. Maybe you guys can talk into the VC, and we can exchange notes. I can give you my inputs on those issues, and hopefully that helps you trade more successfully. But yeah, that's pretty much the gist for today. If there's anything, feel free to ping me in Discord. I don't see anybody asking any questions, so that's pretty much it for now. But yeah, 31st we'll talk about momentum cycles and talk deeper into what to do, how to do, and how to look at it, how to look at gold, long-term perspective, right? But yeah, with that, I'm gonna head out. It's night for me. I'm gonna get food. I hope you guys have a great weekend. For those in Canada, have a great long weekend. Enjoy yourselves. I will see you guys back. I will leave my streams running starting Sunday, but I may not speak in them. But I'll set up my charts. I'll have those chartings kind of ready today itself, so it'll be up for stream and posts inside of our Discord. So yeah, I'll see you guys back Monday Asian session or Tuesday Asian session. Till then, have a good one.